The glow of your screen is the only light in the room. You're refreshing the chart for the 10th time in a minute. That meme coin you bought yesterday, the one all the threads said was a sure thing, is down another 10%. Your stomach is tight. You're not even thinking about profit anymore. You're just hoping to get back to break even so you can get out and promise yourself you'll never do this again. You just wanted to make a little extra cash. You weren't trying to be a whale. You were just doing what everyone else seemed to be doing, trying to be an average trader, making average gains. My name is Sam, and for years I've watched people, smart people, walk into crypto with that exact same plan. And I've watched that plan systematically dismantle their money and their mental health. Not because they're stupid, but because they misunderstood what average actually costs. Let's start with the biggest myth in the room, the myth of the average return. You've seen the headlines. Bitcoin has averaged 100% returns a year over the last decade. Your brain takes that and creates a benchmark. You think, okay, if I can just be average, if I can just match that, I'm doing great. Here's the brutal truth. That average return is a mathematical ghost. It doesn't exist for you. It never did. That number assumes one thing. It assumes you bought a lump sum at a random point, and then you held. No selling during a 50% crash. No buying more when it was screaming up and everyone was getting rich on Twitter. No panic, no greed, no emotion. Just a robot that bought and forgot. How many people do you know who are that robot? Right, 0. So, if the asset returned 100% a year on paper, what does the average trader actually get? The data from traditional finance is grim. Studies by firms like Dalbar show the average investor in stocks, which are way less volatile than crypto, underperforms the market by about half over a 2-0-year period. They get maybe 4% when the S&P gets 8%. Now, take that gap and apply it to crypto's roller coaster. The underperformance isn't just a gap, it's a canyon. Let's actually do the math on this. Let's take a real period. Say, from the start of 2020 to the start of 2024, Bitcoin went from about $7,200 to around $63,000. That's a buy and hold return of about 775%. Your $10,000 turns into $87,500. That's the headline number you anchor to. Now let's trace the average trader's path through that same period. They don't buy at 7,000. They hear about it in late 2020 when it's already run up to 11,000. That's their first buy. It rockets to 64,000 in 2021. They're euphoric. Then it crashes back down to 29,000 in the summer. The fear is palpable. They panic and sell. They lock in some gain, but they're shaken. Then hype builds again late in the year. It's back up near 50,000. FOMO takes over. They re-enter. Then the real bear market hits. It grinds down to 16,000 over 2022. The pain is too much. They sell in despair near the bottom. After that whole emotional marathon, after all those decisions that felt right at the time, what's their actual return on their original capital? It's messy, but a realistic estimate is maybe 120%. So you have the asset returning 775%, and you have the average trader getting 120. The cost of being average, 655 percentage points left on the table. On a $10,000 investment, that's $65,500 you paid for the privilege of following the crowd. Let that sink in for a second. You thought average was safe. It's the most expensive ticket in the building. So if we're not getting the average return, what are we actually paying for? Let's itemize the bill. Beyond the tiny spot trading fee on your exchange, you're paying 3 silent fees that never show up on your statement. The first is the emotional toll fee. This isn't just about stress, it's about the financial drag of that stress. Poor sleep leads to impulsive trades. Chasing losses leads to revenge trading. If your emotional state causes you to make just one poorly timed trade a month that costs you 0.5% of your portfolio value, that seems tiny. but that's a 6% annual drag. That's like paying a 6% management fee to your own anxiety. And most people pay way more. The second fee is the volatility timing penalty. Crypto doesn't go up in a straight line. It goes up 25%, down 20, up 40, down 15. The buy and hold investor rides that whole wave. But the average trader gets on and off at the worst times. They buy after the 25% pop because that's when confidence is high. They sell after the 20% drop because that's when fear peaks. They capture the worst parts of the sequence. Let me be clear about something. This isn't bad luck. It's the predictable outcome of human psychology meeting a volatile chart. The third fee is the social proof surcharge. This is the cost of buying when everyone else is buying. Think about Google search trends for Bitcoin. The peaks in search volume, when everyone is talking about it, almost always coincide with price tops. Buying at peak social sentiment means you're systematically overpaying. You're paying a premium for the comfort of knowing you're not alone. That comfort has a price tag, and it's often 10, 20, 30% of your entry capital. Now, here's where it gets interesting. These fees aren't random. They don't just vanish into the digital ether. Your lost percentage points have a beneficiary. Actually, they have three. Your capital, lost through these silent fees, systematically flows to three entities. And understanding this is the key to understanding the whole game. The first beneficiary is the patient holder. You know them as the hodler. On-chain data is crystal clear here. During bear markets, the percentage of Bitcoin supply held by long-term holders consistently increases. Who are they buying from? They're buying from the average traders who are selling in despair. The weak hands transfer assets to the strong hands at a discount every single cycle. In the last bear market, long-term holder supply hit all-time highs. Your panic was their accumulation signal. The second beneficiary is the algorithmic contrarian. This is the cold, unemotional capital on the other side of your most confident trade. Look at perpetual swap funding rates. When the average retail crowd is extremely, overwhelmingly long and bullish, funding rates turn positive. That means the longs are paying a fee to the shorts. Who's short? Often, it's sophisticated money taking the other side of the retail frenzy. The average trader, convinced by social proof, literally pays a continuous fee to the entity betting against their emotional peak. The third beneficiary is the network itself. When the average trader gets scared, what do? They sell to stablecoins, USDT, USDC. Then they think they're being smart by putting those stables in a DeFi pool to earn 5% yield. Seems prudent, right? But step back. They just sold an asset with a potential 100% plus upside over a cycle for the safety of a 5% yield. Their fear provides liquidity to the network. The network's liquidity pools earn a spread on that fear. You sold your lottery ticket for a packet of gum, and the corner store made a profit on the transaction. This is the winner's triangle: the patient holder, the algorithmic contrarian, and the network protocols. And their revenue source? It's the predictable, emotionally driven behavior of the average trader. You are not just failing to win, you are an essential, revenue-generating component in someone else's winning strategy. Your average behavior is the feedstock. That might make you angry. Good, it should. But anger without a plan is just more fuel for the machine. So, is the answer to become a genius trader? To outsmart the algorithms and the HO dealers? No, that's just another trap. The escape is simpler and harder. It requires less activity, not more. It's about becoming anti-average. I want you to think about a personal protocol. Call it the 9055 rule. Allocate 90% of your crypto capital to a defined, conviction-based, long-term portfolio. This isn't a random bag of coins. This is, say, a simple 60% Bitcoin, 40% Ethereum split. You set it and you forget it. No checking it during a crash. No tweaking it because some influencer said so. The 90% is on autopilot. Then, you have 5% for truly asymmetric, high-conviction opportunities. Not chatter-based opportunities. Not this guy on Discord is smart opportunities. I'm talking about deep, personal research on a project that you understand, where the risk-reward is massively skewed. The goal here isn't to be right often, it's to have the potential for a 10x if you're right. You'll probably lose this 5% more often than not, and that's okay because it's capped. The final 5% is cash. Stablecoins. This is your extreme fear reserve. This is not for trading. This is for when the market is down 60%, Twitter is dead, and no one wants to touch crypto. That's when you deploy this 5% into your 90% allocation, buying more of what you already believe in at a discount. This framework forces inaction when the crowd is hyperactive and action when the crowd is catatonic. Let's make this concrete with a story about two people, Maya and Ben. Maya is in 15 crypto Discord servers. She's diligent. She sees an alpha call on a low-cap project. She does her research, reads the pinned posts, and invests $2,000. It pumps 50%. She feels validated, part of the in-crowd. She doesn't sell. It then dumps 70%. Her loss isn't just the $1,400. It's the $10,000 that $2,000 could have become in her core portfolio over 3 years. She paid the social proof surcharge. Then there's Ben. Ben believes in HODL. He bought Bitcoin early. In 2021, when his portfolio is up 5x and crypto is on CNBC, he feels rich but nervous. His co-worker sells to take profits. Ben, wanting to be prudent and not greedy, sells half. He locks in gains, but then he watches the remaining half double again. To get back in, he buys a trending altcoin. It crashes. Ben's responsible, average action of taking profits guaranteed he would underperform his own original conviction. He paid the volatility timing penalty. The math of restraint is the most powerful math in finance. Think about the opportunity cost of just one bad trade. Say the average trader makes one major emotional trade per quarter that costs them 15% of the capital they deployed. Just avoiding those 4 trades a year adds roughly 60% to their annual performance. Not losing money is a skill. It's the most profitable skill. The real cost of being an average crypto trader isn't measured in fees. It's measured in the forfeiture of your own potential. It's the life-changing sum left on the table because you sought the comfort of the crowd. It's the future growth you sold for present-day certainty. The system is designed to harvest your average impulses. The path out isn't about finding better signals or joining a better group. It's about building a protocol that protects you from yourself. It's about understanding that in a game designed to profit from human nature, the ultimate edge is to be slightly less human when it matters most. Your portfolio isn't a measure of your intelligence. It's a ledger of your psychology. And the most valuable trade you'll ever make is rewiring the part of you that wants to be average.